Hello and welcome to Between the Lines, the podcast that dives deep into the stories redefining Asia Pacific's reinsurance landscape. Recorded here in the newsroom of InsuranceAsia News in Hong Kong. I'm Mithun Varkey, Editor-in-Chief for InsuranceAsia News, and in this edition, we'll discuss the latest cat bond offering from Peak Re, our exclusive on specialty wholesale broker BMS exiting some Asian markets, and energy transition in Asia. We'll also bring to you the latest stories that our reporters are working on. In this episode of our podcast, we'll be joined by Iain Reynolds, Head of Third-Party Capital at Peak Re, to discuss their latest cat bond and the broader ILS market.
So I think there are no barriers to more ILS activity in Asia from an infrastructural point of view. Whether the appetite is there, I think it would be fair to say we haven't seen as much interest from Asian investors as we would like to. And we do welcome efforts by various parties to educate the investor community about the asset class.
Today we have our full team present in the newsroom. Delighted to welcome Deputy Editor Andrew Mullen.
Good morning.
Special Projects Editor Kristina Shperlik.
Hi.
And reporter Joana Nguyen, who is this week relocated from Hanoi to Hong Kong. Joanna, welcome. How does it feel to be in Hong Kong and working with the team in the office?
Thanks, Mithun. It's been a great start so far. I'm very excited for the time ahead.
Great. Hope you enjoy Hong Kong. Last time we were dialing in from Hanoi.
Right. Last time I was recording from my bedroom facing the wardrobe, but now in the studio is a different atmosphere, more professional and more, authentic feeling talking to you guys. So yeah, it's good.
Great. Good to have you here and hope you enjoy.
Right. Thank you.
Andrew, it's been a busy couple of weeks for the insurance industry in Hong Kong. The Insurance Authority seems to be making some progress towards its ambitions of making the city a risk management hub. What can you tell us?
Yeah, well, on our last podcast, it did seem a bit doom and gloom for Hong Kong. We had Swiss Re Corso closing its office here, but things seem to have picked up with Peak Re issuing its $50 million cat bond. This secures protection against Japanese typhoons and earthquake risks, as well as earthquakes in China and India, through its Hong Kong domiciled special purpose insurer Black Kite Re. This is a multi-peril, multi-territory cat bond, and it's the first by an Asian sponsor from an Asian domicile. It is also the second cat bond issued in Hong Kong this year, after Taiping Re issued a bond in January. Also in Hong Kong, HSBC has announced a new captive to provide reinsurance for risks related to employee benefits and other HSBC markets in Asia. And it's the first captive insurer established by a multinational enterprise based in Hong Kong.
That's two big announcements from Hong Kong. Kristina, you had a big exclusive on BMS scaling back in Asia. Can you give us the details?
Yeah, so we know that BMS just closed down its 2 offices in Asia, one in Japan, one in Korea. And we know basically this is how, because they have also one office in Hong Kong and one in Singapore. So in Korea and Japan, they were doing M&A insurance, which is W&I and tax. So the market sources I spoke to were not sure about the reasons, but we could assume this is because the M&A landscape is still sluggish. It's not recovering as fast as we were expecting. And I would imagine that Japan market, which is one of the biggest drivers of M&A activity in the region, is also very competitive.
And Kristina, with all these situations, there's obviously a people element to this as well. Office closures means people either being relocated or losing their jobs.
Yeah, you're absolutely right. So BMS had 2 employees in Japan and 5 in Korea. And all of them, except one person in Korea, will be let go. And this is very interesting because they just expanded into Japan in 2023.
That's a quick scale back for BMS. Clearly, the expansion of the region is not going to plan. Moving on, I think one of the stories that really caught my attention last week was Swiss Re Institute's Sigma report, which I think is quite interesting because we have had quite a lot of conversations around the risk of secondary perils. But the Sigma report points to the significance of peak perils. So the report said that hurricanes and earthquakes and other peak perils could drive global insured losses to up to $300 billion or more in a peak year. It serves as a reminder not to lose sight of the fact that peak perils are still the biggest loss drivers for the industry. And we've had a few earthquakes recently around the region, and there's been quite a few stories around it. Andrew, you've been looking into some of these stories. Can you tell us more?
Sure. I mean, the main one actually isn't a recent one. This is one from 15 years ago. It was actually touched on our last podcast, how Kiwi insurer Tower has been receiving claims from the Christchurch earthquake 15 years ago. A reminder, this was one of the world's largest natural disasters with total insured losses of more than 31 billion New Zealand dollars. So Tower said this increase in cases was due to an unexpected rise in new over-cap claims from the National Hazards Commission. This was in one of their financial reports, so we reached out to the Commission to find out what this actually meant. And they told us that at the moment they're dealing with 555 what they classed as reopened claims. And to provide some context, they told us that of the 469,000 claims that were all settled in 2016, in total 42,000 of those have been reopened. So even though it's 15 years ago, insurers are still being impacted by claims which are for still finding damage from the earthquake. When someone moves house, they find some damage, or actually when some repairs were made and they weren't actually done up to standard. So this is still impacting the insurers today.
Talking about New Zealand, it's interesting because Insurance Council of New Zealand just released some new numbers for the last financial year and actually for the last decade, or even like going back to 2010. So since 2010, earthquakes accounted for 80% of all the insurance claims in the market. In Japan as well, we just got some numbers from the General Insurance Association of Japan. And we know that the Naoto Peninsula earthquake was the largest event in terms of claims for financial year 2024. So now the insurance payouts exceeded $2 billion.
Wow, $2 billion.
Yes, just like Swiss Re Institute is right.
And we've had more earthquakes recently in Myanmar. We've had one in Turkey again, and recently, I guess, in Chile as well. Thank you for that. Joana, quickly following up on our chat last week about your product recall story. It almost seems like an instant reaction from the market. We've seen 2 new product recall MGAs enter the market. Have you been looking into it?
So last time when we discussed product recall trends in Asia Pacific, we knew that there is significant capacity from London as well as new market entrants. And, just a couple of days ago, Blue Niche, which is a product recall specialist MGA based in London, secured an increase in underwriting capacity for 2025 to $20 million. They also gained additional capacity to cover risks in China as well.
So that was in China, but wasn't the other example from Australia?
Right. So another example is Market Lane, an MGA from Australia. A few days ago, they introduced new product recall policy with capacity of, $1 million Australian dollars or over 645,000 USD. This is one of their new offerings besides product contamination and environmental impairment liability, as they rolled out their new division called ML Specialty, focusing on niche insurance solutions.
That was some predictive intelligence in our story where we said there'll be new capacity coming in. That was quite interesting. Talking about energy transition, we just published a long form report. Kristina, you're the primary author of the report. Can you take us through it?
Yeah, actually, it's very long. We spoke to many people. The report has many graphs. But the main thing is we know that the energy transition is underway across the region. We know most of oil and gas giants are going through some sort of transitions, and underwriters are also transitioning with them. So we see that energy portfolios are basically moving from a high volatility, low frequency claims to a low volatility, high frequency. Also, insurance capacity is growing, not only in Singapore, but in markets like China, India, and South Korea, which means the market is moving into sort of softer phase with broad appetite.
So what is pricing being driven by?
This is a good question. Pricing in general for renewables, and especially in Asia, is driven by multiple factors. The main challenge, of course, is nat cat exposure, but also it really depends on technology that each project is using. For example, we know in general that the pricing for renewable energy market in Asia is still stable, but it has started to soften.
Thank you, Kristina. That's a few really good stories that we've had in the last couple of weeks. Looking forward, what's on the agenda?
Well, I think actually, Mithun, the biggest story we were looking at is the story you're going to be working on with the war in India and Pakistan, which has been developing.
Yeah, that's certainly the biggest story around as we record. Tensions between India and Pakistan have been going on for a long time, as we all know, but it came to a head a couple of weeks ago when terrorist attack in Kashmir, the contentious northern part of India, terrorists killed 26 people, which India alleged were backed by the Pakistani state. The Pakistan government has, of course, denied any involvement in that. But tensions have been simmering for a while. But on Tuesday night, India fired several missiles into Pakistan. I think according to India's defense ministry, these were precision attacks targeting 9 sites of terrorist infrastructure in Pakistan and Pakistan-occupied Kashmir. India said no Pakistani military facilities were targeted and said the attacks were focused, measured and non-escalatory. But the Pakistani government has since come back and said this is not an act of war and that they will retaliate. So there's not going to be any easy end to this. In fact, I think India has already asked for mock drills across the country, even for small towns at the southern tip of India, which is usually far away from these skirmishes. This is going to play out, and it'll certainly have an impact on the war insurance market, the political violence and terrorism market as well. We'll see an impact on both pricing and demand in the coming days.
I think it's interesting how the political violence market will react to so many wars happening at the same time in the Middle East. Obviously, Russia, Ukraine, India, Pakistan, and China-Taiwan war risk seems like it's becoming more real. Even before that, like 2 years ago, we had a story on China-Taiwan war risk. And at that time, we knew that underwriters already excluded Taiwan completely or sublimited exposure. At the same time, I guess the impact of China-Taiwan war would be bigger in terms of economy, right? Because of semiconductors.
True. I think the potential of a China-Taiwan war is going to be bigger on the industry as a whole. But I think a war is a war, and I think that'll have an impact on the broader market globally. It's not going to be easy days for political violence underwriters around the world. Changing subjects here. Joana, I believe you're working on a medical malpractice story.
So I talked to the industry and they told me that the demands for medical malpractice insurance is expected to be on the rise as, patients are getting more aware of their legal rights and they have higher expectations in terms of medical treatment and outcome. And also given the benign litigation activity and the amount of losses in Asia compared to Western countries, this business line has attracted more capacity to the region. So I'm reaching out to other insurers and brokers to understand this more and see if they share the same viewpoints.
Great, that sounds quite interesting. Thanks, Joana. Looks like we have a pretty full plate here and lots to work on in the coming days. Let's get to work. In our featured interview today, we're joined by Iain Reynolds, Head of Third-Party Capital at Hong Kong reinsurer Peak Re. Iain's a cat modelling expert, and he's going to discuss Peak Re's latest cat bond, as well as the broader ILS market. Iain, thank you for joining us. How are you doing?
Very well, thank you, Mithun. Appreciate the invitation.
It's a pleasure to have you with us. Congratulations on the latest cat bond issuance from Hong Kong. Can you tell us a little bit about the latest cat bond and what drove the decisions to issue the latest bond?
Well, thanks, Mithun. Yeah, we're very pleased with the success of the transaction. Why would we want to do a cat bond? And there are a number of reasons. The most obvious is that we would be interested in this from a risk management perspective. Obviously, since the last issuance, the regulatory regime has changed. So we are now subject to Hong Kong RBC. And that is a consideration in how we look at any retrocession transaction. And there are softer factors too. I mean, obviously this makes an interesting podcast, that helps. But really what we're interested in is the risk management aspect and the solvency relief that we get from that. And to that end, we think about what are our peak perils, which markets are important to us, where do we foresee growth that we might want to support over the next 3 years. And, our core markets are in Asia Pacific. We have a focus on emerging Asia, as well as the more developed markets in Asia Pacific. And really our where we foresee our peak and our growth potential is in Japan, in India, and in China. And we're very excited to bring India and China to this market. We're not the first to bring China to the catastrophe bond market. We believe we're the first to bring India, and we're certainly the first to bring India on a Type 144A catastrophe bond. Yeah, so our motivation was really the risk management and the solvency aspect of what an instrument like this can do for us. Ultimately, the real utility of this cat bond is to help us help our clients. in their growth ambitions in each of these markets.
I believe this is the first multi-peril, multi-territory bond issuance by a nation-domiciled special purpose reinsurer. How do you come to that? I mean, your first bond was obviously Japan wind, but this one's a bit more complicated, if I would say, with different triggers, with different perils, with different markets. Can you tell us about what went into bringing the bond together?
Great question. I think it's probably pertinent to make a comparison between our thought process in 2022, when we issued the first deal. Innovation is important to us, but we also had to consider execution risk. This was a first-time issuance for Peak Re in 2022, and the first time that a 144A cat bond was issued in Hong Kong. So we weren't the first Hong Kong cat bond, but we were the first Rule 144A deal. And so there were elements of execution risk in what we were doing, and so we were a little more modest in terms of what we wanted to cover. We had a clear necessity to cover our Japanese wind exposure, and so we focused on that. Roll forward to 2025. Obviously, 3 years is a long time in the market. We've seen a lot of changes. Our risk profile has changed. Our other retrocession covers have changed, and therefore what we see as growth opportunities in the market have changed. And to that end, we decided that we needed to cover these other perils. We're interested in innovation. India is a very important market to us. Indian perils haven't been introduced to the catastrophe bond market, at least on a 144A basis previously. And China is very important to us. So we wanted to be a little more ambitious in the scope of what we did, and therefore we chose to include China and India. In terms of a choice of trigger, I can take you through our thought process. I think in convention states that reinsurers can't place catastrophe bonds on an ultimate net loss basis, on a pure liability basis. There's no written rule on this, but no one has done this for a very long time that we're aware of on a 144A deal. So all reinsurers are using indexes when they place a deal. And then it comes down to what's the choice of index that we would use. Our primary preference would always be some sort of industry loss trigger because it eliminates some of the uncertainties around parametric triggers and some of the basis risk. So, for example, if we take the example of typhoon, a lot of loss comes from rain in a typhoon, which is very difficult to parameterize, to sort of condense that into a usable parametric trigger.
Right.
But it's automatically captured by an industry loss. So where we believe there is a reliable industry loss index, or at least a proven industry loss index, our preference is to use that. And that's why we've used that for Japan, because we know that the index provider has a proven track record in these markets, and we understand. Much as we like the index provider, and we do like what they do, it's fair to say that an industry loss trigger for China and for India is untested. Okay. We haven't yet seen how that behaves. And so we felt less confident in using an industry loss trigger in those markets. I think it's also fair to say that we would expect in China and in India that most of the damage from an earthquake would come from ground motion and from shake, right, rather than urban conflagration or tsunami. It's not impossible, but that's really what we think drives the risk. So we think ground motion is the real trigger here. We think we can structure a workable parametric trigger for these perils. So it's partly driven by the lack of a tested industry loss index. It's partly driven by the nature of the risk. And it's partly driven by the confidence that we have in the risk that we assume. And that's really what drives our thinking about using a parametric trigger for India and for China.
Something that you mentioned when we spoke last time was about the parametric trigger. The payout is on the actual loss. Could you explain how that works?
Certainly, yes. So we have a reinsurance contract with a special purpose insurer. So this is not a pure derivative product. It's a reinsurance product for us. So while there is, in theory, positive basis risk in using a parametric trigger, and by positive basis risk, I mean that we could, in theory, trigger a claim larger than our actual ultimate loss, we wouldn't be able to claim above our actual ultimate net loss. So there is a clause in the reinsurance contract which says that we can only claim as much as we actually lose in dollars. So we couldn't make money from this, from a loss, essentially. This is quite typical for any index loss, and it's also true for the industry loss indices. Now, in practice, we think this is not something we're likely to encounter. We have calibrated this to only respond for particularly severe losses.
So the possibility of the loss being much lower than what the payout could be.
So we carry basis risk both in terms of it's possible that we could suffer, a dollar loss which wasn't properly reflected by the parametric trigger. We would refer to that as negative basis risk.
Right.
And it's also possible that there is positive basis risk that the trigger over responds compared to our actual insurance liability loss. But in the case of an insurance liability loss below the index recoverable, we can't actually recover more than we lose.
Interesting. I mean, one of the big differences from 2022 when you issued your first bond, the industry has gone through a bit of a reset. I mean, a few years ago, there was probably difficulty. There's a lot of capital trapped and there's difficulty finding capital, but the market sentiment seemed to have changed and there's quite a lot more interest in cat bond, and there's been record levels of catastrophe bond activity in the last year, and certainly looks like it will be another record this year. How is your experience different from a bond issuer perspective between 2022 and 2025? Are you seeing more demand, more interest from investors, more appetite?
I think in both issuances, we saw plenty of appetite. I think, as you said, the market is very healthy at the moment. In a way that works both ways. There's plenty of capacity available. Investors are looking for deals, but they're also being offered quite a lot of deals. So you're fighting for attention a little bit in this market. But no, we were very pleased with the response from investors, and we managed to generate more interest than we needed, and we placed the capacity we wanted.
That's interesting, Ellen. There's more bonds and more deals on the market, attracting more attention. Well, when we spoke about the reset, and certainly the market seems to be softening, certainly in Asia, and we haven't seen sort of demand growth, certainly at 1.1 and 1.4. The demand in Asia Pacific has been flat, or in some cases even lower. How do you see the supply dynamics play out? I mean, we know that you've done a smaller cat bond issuance this time around. Do you think there is excess supply in the market? How do you see the market play out?
Okay, I think that the only answer here is a macroeconomic one. And we're seeing a lot of macroeconomic uncertainty that has not yet fed into the supply dynamic of our market, but it would be optimistic to assume that it couldn't. And I think while there's macroeconomic uncertainty, it's very difficult to make predictions about how the reinsurance market itself will play out.
Coming to the broader ILS market in Asia Pacific specifically, I mean, it's still a much smaller market compared to what we've seen in Bermuda or London. How do you see the market evolving in the region? This is your second bond issuance. How do you see there's better ecosystem around the region and for a bond issuer?
And there are a number of ways to address that question. I think, firstly, our experience of using Hong Kong as a domicile for this bond was pretty seamless. So we are impressed by the ease of how you can issue ILS in Hong Kong. We don't have the experience of Singapore, but I haven't heard anything negative, so we assume it works well in Singapore. And that's particularly true for a reissuance. So the ability to reuse the same special purpose insurer was very helpful and aided the efficiency of the placement. So I think there are no barriers to more ILS activity in Asia from an infrastructural point of view. Whether the appetite is there, I think it would be fair to say we haven't seen as much interest from Asian investors as we would like to. And we do welcome efforts by various parties to educate the investor community about the asset class. And we support those activities ourselves. I think in terms of demand from issuers, I can't really speak for the rest of the market. An observation I would make is that going back to when we were talking about triggers, the lack of reliable or proven industry loss triggers is perhaps a barrier. And if we do want to promote the asset class more for sponsors, I think more work on some of the triggering indices would definitely help.
I mean, there are sponsors who would want more data, more reliable indices from around different markets in the region. I mean, Japan is perhaps an exception.
Japan has had some very big losses, so we understand how those industry loss triggers work in Japan, and we are aware of some of the more detailed data available from the index providers. We don't have that in China, for example. Clearly, there's a great potential for the Chinese market to be served well by the cat bond market. I think for treaty reinsurers, who are possibly the more natural sponsors of cat bonds covering China, more data and more indices would definitely help.
Thank you very much for joining us today, and congratulations once again on the successful issuance of your second cat bond from Hong Kong.
Thanks, Mithun, and thanks for your time as well.
That's all for this episode of Between the Lines. Don't forget, you can connect with us on LinkedIn and subscribe to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Mithun Varkey. Thanks for listening.